It's time for the Your Personal Bank Show with Ferenc. In an era of chaos, confusion, and craziness, Ferenc is a voice for common sense. As a financial literacy educator, speaker, and entrepreneur, Ferenc cuts through the noise to help us understand how current events affect our money, economy, and our freedom. Now, here's Ferenc.
Welcome to the Your Personal Bank Show. This is Ferenc. If you want to reach me, you can do so at yourpersonalbank.com. Yes, you will reach me. It's yourpersonalbank.com. The last 2 weeks, I've been discussing the record valuations of the S&P 500, particularly the tech sector. I'm not going to belabor the point too much further this week. I got a couple of key points I want to share, and then I'm going to move on to some other news that's significant, like the bond market, real estate, and things like that, that I've kind of put on the back burner because of the historic news of the stock markets. If you want more detailed information on that, I'd highly recommend going to my website or the Your Personal Bank app. You can listen to this or any of the previously recorded shows anytime you like. Each has its own topic. The key points I want to make today, relatively briefly, is this. I see a major short-term risk to the markets and a much bigger longer-term risk overall to the markets that I think should not be ignored. It's no secret that the tech sector has driven this record-setting, all-time record-setting increase in valuations. About 10 stocks in the S&P 500 have led the charge, particularly the Magnificent Seven, and those have been led by Nvidia. Now, Nvidia has benefited from this AI revolution because if you think of this AI burst of activity like the gold rush, Nvidia is the company that's selling the picks and shovels for the miners to go dig the gold. They're providing the chips that AI needs to run and grow on. And they've benefited tremendously from this. There is no doubt about that. But cracks are starting to show with Nvidia. In their latest earnings call, it turns out that over 50% of the data center revenue comes from 3 customers. How would you feel if just 3 customers made up about half of your total sales? It's not a comfortable position to be in for a number of reasons. There's no diversification of a customer base. If one or more of those big 3 purchasers of your chips decides to scale back purchasing for whatever reason, goes to a competitor, or decides to start producing some of the chips themselves to save money, the hit to your bottom line, your profits, can be quite significant. And this record-breaking asset valuation could easily be impacted in a very significant manner if one of those things happened. It turns out one customer alone of Nvidia's made up more than 20% of its total sales. And although many investors and companies are still bullish about AI tech, the fact that so much of their sales is tied up in literally just 3 companies has to keep some of their executives up at night. Now, it's really not hard to guess who most likely are those big 3 customers. There's only a handful of companies that would have the wherewithal or need to be spending tens of millions of dollars on chips. One that comes to mind, of course, is Elon Musk. He recently has broken data center records. Turns out he set up over 100,000 Nvidia H200 GPUs in a record 19 days just last year. This is something that typically takes years to finish. And Elon Musk has discussed about installing many, many more data centers to run his XAI. OpenAI and Oracle also signed a deal to build significant data centers with over 200 million AI chips. Meta purchases a lot of Nvidia chips and has been in the news with data centers. So it's not hard to figure out who those 3 big customers might be. It's one of those, most likely. And again, if any of those, for whatever reason, pull back on their spending, either through choice or by force, that could have a significant impact on Nvidia's earnings, which would have a massive impact on their stock stock price, and being the flagship of the AI revolution would be tremendously bad news for valuations across the board, particularly in the tech stocks. The other issue short term is the AI learning gap. This is fueling investor concerns because it turns out it's taking a lot of companies and people longer to learn how to adapt and use AI than many of the tech CEOs envisioned. If you understand human nature, it's not a surprise, but it goes against the hype of what we've been hearing. And it's kind of funny. I saw this article where humans are being hired to make AI slop look less sloppy. This one graphic designer they discuss in this article was supposed to be out of business, but she's busier than ever, working with clients on fixing their botched attempts at AI intelligence-generated logos. As she points out, the illustrations are typically littered with unclean lines, nonsensical text. They look like it's a mess of pixels when they're blown up beyond a certain size. So what's funny is the thing that was supposed to replace her job has actually increased her workload. The article goes on and discusses other areas where people are having to be brought in to fix AI's incompetencies. Things like writers are asked to spruce up ChatGPT's writings. And artists are being hired to patch up wonky AI images. Even software developers are fixing buggy apps coded by AI assistants. And as they point out, most Gen AI systems do not retain feedback. They're not able to adapt to context or improve over time. The core barrier isn't scaling, infrastructure, or regulation, or talent. It's just learning. It's not very good at learning from its mistakes yet. That's something that human beings still shine far more than generative AI. Now, that may change at some point in the future. I'm not saying AI won't. I've discussed that many times on the show. But I've also stated, using a little bit of common sense and reason, that it's probably going to take longer than the hype we've been hearing, and we're starting to see that very thing come true. In fact, OpenAI execs can't stop talking about not having enough GPUs or enough infrastructure to be able to take the next step on artificial intelligence. Sam Altman, CEO of OpenAI, has mentioned that they need to spend trillions on infrastructure to get AI scaled up to be able to take it to the next level. And that's some of the reasons why so many people are now talking about an AI bubble. These are major concerns. These are delays. These are frustrations. These are challenges. The part of normal everyday life, by the way. This is typical. We saw this in the dot-com bubble. I use that analogy so often because it's so appropriate. Silicon Valley sold us on the idea that the internet would fundamentally change the economy. It did, but it took about a decade longer than the hype and what they were promising. When you're taking on a challenge this size, incorporating a new technology, there's always frustrations, delays, and challenges. There's infrastructure that has to be built, and then there's the adaptation for people to start using it. And what a lot of Silicon Valley tech pioneers don't realize is most of them are early adopters. They readily take on new technology and adapt to it much faster than the average person, the average human being does. They have a far greater understanding, and they also have a far greater interest in learning how to adapt. While the average person's out there just living their life, and if they see a situation where something could benefit them or make them more efficient, oftentimes they'll take on that new technology, but understand there's a learning curve process also. And if somebody's already busy in what they're doing, people feel like it's like taking on a second job, having to learn all this new stuff to make my job more efficient, which in the long run might benefit them, but in the shorter term, it's a challenge. It's a balancing act, right? I've discussed this recent MIT study that found 95% of AI pilots don't generate measurable financial savings or boost company profits. They surveyed hundreds of executives, employees, and projects. And these implications are big because the report found that between the 30 to 40 billion invested into this generative AI and 95% of it not generating any benefit at least so far, that's not a promising outlook for people to continue to invest in this until the systems improve further. Even Meta, who spent millions on a super intelligence AI team, it's downsizing its AI division. Meta has even implemented a hiring freeze in its AI division. Meta was one of the pioneers of the AI development, and they're pumping the brakes. So that should tell you something. The extreme valuations can continue to go up longer than is rational or reasonable even, because there's a lot of emotion involved, there's a lot of hype, but it also can turn very dramatically and very quickly and very aggressively. So my suggestion is proceed with cautious optimism and protect your downside. You can do that with your personal bank or annuities. It's the best time in over 40 years. It's the golden age of fixed assets. You can still take advantage of future upside, unlimited upside growth with no downside losses because the principal's protected. So you could still take advantage of this while locking in your gains. If you want more information, contact me at yourpersonalbank.com. Next segment, I want to share a bigger, longer-term issue that everyone should be aware of, not only with the markets, but with interest rates, borrowing costs, and all that. So stay tuned.
Stay tuned for more common sense from Ferenc. For more information, contact Ferenc at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. Welcome back to the Your Personal Bank Show with Ferenc Toth. Want more information? Contact Ferenc at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. Now back to the show with Ferenc Toth.
Welcome back to the Your Personal Bank Show. This is Ferenc. If you want to reach me, you can do so at yourpersonalbank.com. Yes, you will reach me. It's yourpersonalbank.com. In the first segment, we discussed the shorter-term risk involved with the current sky-high valuations in the markets. We're seeing the highest S&P, PE ratios, or however you want to measure it. It doesn't really matter. The highest numbers, valuations we have ever seen in history, including 1999 and even 1929. The risks are significant. The concentration in the stocks and even who these companies are selling their products to is extraordinary, and the level of risk is extraordinary. There are cracks showing up. Many are starting to call this an AI bubble, and they're really asking the question, when is it going to burst? We will see. That's the short-term risk I see. Could occur in the very near future, frankly. And if you want to protect yourself from that, still benefit from the upside, tremendous unlimited upside without any downside risk, contact me at yourpersonalbank.com. But there's a bigger, longer-term risk to the overall markets, interest rates, borrowing costs, our economy in general, that cannot be ignored and you need to be aware of. And this is significant because it's not just happening in the United States, it's happening across the world. And this has to do with the bond markets. That despite the fact that central banks across the world, outside of the Fed, have been aggressively cutting interest rates, yet at the same time, bond yields are continuing to rise. This is occurring in France, Japan, Germany, Canada, the UK, and the United States. In fact, in the UK, the 30-year bond yield officially just broke over 5.7% for the first time since April of 1998. That's a long time, folks. We're talking about some historical stuff going on here. And what makes this especially astounding is this historical high yield of the bond has happened after the Bank of England cut interest rates 5 times. Yet they're at a 27-year high on yields. The markets are literally ejecting interest rates cuts, and it's due to deficit spending and inflation. You don't want to ignore this. Something is big going on, and something big wrong is going on in the economy and the markets. Let's take a look at Japan for a minute. Japan's 30-year government bond has now increased over 30 times higher than it was in 2019. The bond markets are sending a very crystal clear message. Even countries that don't have a lot of debt, like Germany, are being affected. Germany, with a AAA rating, limited debt, one of the best financials for an advanced country, are seeing their bond yields rise also, and it's primarily due to increases in defense spending and energy spending in their case. And what's ironic is the Fed is now considering lowering interest rates for the first time in 2025, despite the fact that the bond market, bond yields are hitting the highest levels we've seen since the 08-09 financial crisis. Inflation rates are floating at about 3%. And why does this matter? Well, government bond yields are the backbone of any economy. They influence mortgage rates, car loans, business credit, stock markets. When yields rise on bonds, the cost of money goes up everywhere. Costs more to do business. Costs more to borrow money. That's a drag on the economy. That's a drag on earnings, typically a drag on stock market valuations. Several things are driving this globally. Soaring deficits, public debt, incredible levels of spending by multiple countries across the world. It's just not the US. Higher debt means a country's financial position is weaker. That increases the risk to a bond buyer, so they demand a higher interest rate return or yield for that risk. Inflation, although the fact it has come down from its highs from a couple of years ago, is still stubbornly above the 2-year 2% target that the Fed has set and what many countries set as a target rate for their inflation. And it stubbornly refuses to go away. We saw the same thing throughout the 1970s. In fact, if you look at the history of what happened, it took an entire decade for inflation to finally go away. It started in 1971, I believe, when the first oil embargo happened. Inflation took off. The Federal Reserve raised interest rates to fight inflation. And as they continued to do that, they started to get it under control. And once they sort of kind of had it under control, they would lower the rates too quickly. They did this several times, and each time they did, inflation reared its ugly head until in the late 70s, Paul Volcker raised the federal funds rate to 20% and killed it dead. That was an ugly decade for the economy, for interest rates, for the stock market, everything. The high cost of borrowing, it was an ugly decade financially. But to make matters worse, this time around, is many central banks have lost a lot of credibility. And what I mean by that is even the Federal Reserve has admitted that they kept interest rates too low for too long over much of the past decade, because they were keeping them artificially low for far too long, and that contributed mightily to the current bubble in asset prices that we're seeing both in the stock and real estate markets, for example. The central banks had a lot more credibility in the 70s than they do now because of the actions that they've taken. If they do indeed lower the interest rates in a situation right now where we're looking at bond yields that are 20-plus year highs, inflation still about 50% higher than their target rate, about 3%, according to the government, I predict several ugly things are going to happen. One, inflation will start picking up even further. You lower interest rates, you're most likely going to see higher inflation, which is not good for anyone. The other ugly thing a lot of people are going to realize is the Fed has little impact on longer-term bond yields. Fed interest rates affect shorter-term yields, and the rude awakening is a lot of people think if the Fed lowers interest rates, that mortgage rates will go down, for example. Not necessarily. Typically, indirectly, they have. But the reality is this. Mortgage rates are tied to the 10-year Treasury. You look at the 10-year Treasury rate, and you add 2 to 3%, and that gives you the 30-year mortgage rate. And given what's going on with persistent inflation and record deficit spending, government spending, the longer-term bond yields are not going down. In fact, they're continuing to go up, despite the fact that many central banks across the world are dropping their interest rates. We're seeing that all over the world. Their bond yields are going up. My point is simple. We may see a little bit lower interest rates from the Fed. Short-term borrowing rates might go down a little bit, but mortgages and such probably will not. They might be affected a little. What we're going to also see is there's a floor. The 30-year bond is currently paying about a 5% yield. That kind of creates a floor. And what I mean by that in terms of interest rates, and what I mean by that is this. When you borrow money, there's somebody on the other side of that transaction lending money. So you're the borrower, they're the lender, typically a bank or other type of institution like that. What does a lender want? They want cash flow. They want interest on their loan, the money they loan out to you. What does a bond pay? Interest, cash flow. If they can purchase a 30-year bond from the government, which, despite what you may or may not think, is still considered a safer investment than a mortgage investment, why would they loan to you a mortgage anything less than that? They're not going to. In fact, they're probably going to charge you a little bit more because in the financial world, bonds, government bonds in particular, are considered one of the safest investments out there. So if they can make 5% interest on a 30-year bond, government bond backed by the full faith of the government, why would they charge you any less than 6%, let's say, in a mortgage? My point is simple. Even if the Fed drops rates, even somewhat significantly, we probably won't see a lot of movement in the mortgage rates, and that's going to be a severe disappointment to a lot of people out there. This is part of the reason why you hear the Federal Reserve making the statements higher for longer. And this situation is not going away anytime soon. In fact, over the past month, the federal government has issued over $200 billion of bonds, and the amount of bonds that they have to sell because of the excess spending and previous spending of bonds that mature, we've discussed this on the show many times, that come due and they got to resell them. The level of bonds that they have to sell for the next 5 years, folks, is at historical levels we have never seen. And I'm just talking about the U.S., not the world. The rest of the world has a lot of bonds to sell too. There's only so many buyers. When you have basic economics 101, when you have a bunch of supply, how do you entice those bond buyers to buy? You've got to increase the interest rates. And that's what we're seeing each bond auction as they're going forward. The government has been forced to increase the interest they're offering up, up, up. That's something that's not likely going to change for the next 5 years plus because of the total level of bonds and borrowing that has occurred out there just in the U.S. spending alone. So don't expect interest rates to go down any significant amount for the next 5+ years, probably longer. Now, if you're borrowing, that's bad news. But if you're investing and you want a higher return with guarantees tax-free, that's great news. That's why I call it the golden era of fixed assets. This is why annuities are paying the highest rates and bonuses that they've paid in over 40 years, literally. Unlimited upside, guaranteed downside protection. Got companies are paying up 8% guaranteed the first year, A+ rated. I've got companies are paying bonuses of 15, 17% even. If you have an early surrender penalty on an older annuity, my gosh, now's the time to look at the new products because they're paying so much greater rates of return than the ones even 2 or 3 years ago are paying. If you want more information on it, contact me at yourpersonalbank.com. Stay tuned in the next segment. I got a few more things to share about the bond markets, and then I want to discuss real estate because it's all tied in together. So don't miss it.
Stay tuned for more common sense from Ferenc. For more information, contact Ferenc at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. Welcome back to the Your Personal Bank Show with Ferenc Toth. Want more information? Contact Ferenc at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. Now back to the show with Ferenc Toth.
Welcome back to the Your Personal Bank Show. This is Ferenc. If you want to reach me, you can do so at yourpersonalbank.com. Yes, you will reach me. It's yourpersonalbank.com. And I almost always forget, I also have a Your Personal Bank app, which you can download. Has any of the previously recorded shows on both the website or the app. Each has its own topic. You can listen anytime you want. Many of my clients love listening on the app because they can just have it on their phone while they're walking the dog or checking the email, driving down the road, whatever it may be. They can listen to the show, learn some great stuff, keep up to speed on what's going on out there with our money, our economy, make better decisions, all that good stuff. So again, it's yourpersonalbank.com or the Your Personal Bank app. So as I was stating earlier, there's several reasons behind why the bond yields are higher. We're looking at rates that we haven't seen since the Great Recession, in fact. That's about 27 years ago. We're seeing this as a worldwide phenomenon, not just the United States. There's several factors contributing to this, including soaring debt, public debt, inflation that's stubbornly refusing to go away. Central bank's credibility has kind of been shot. The Federal Reserve, for example, has been doing quantitative tightening, which means they've been selling assets instead of buying them. Typically, to keep yields down, they will buy, but they've been on a selling spree because they had an all-time record, something like $9 trillion in assets a year or two ago. Federal Reserve went from like 2 or 3 trillion of assets pre-COVID to like 9 trillion. It was crazy. And they're losing money like crazy. They're just losing money hand over fist. And they're kind of in a tight situation themselves. They're sort of in a catch-22. Everybody's screaming. I understand politically, folks are wanting them to reduce interest rates, and other countries have been doing so. UK, for example, has lowered interest rates 5 times, yet their bond yields are at a 27-year high. We're seeing the same thing in the United States. It's the bond market that's driving the bus, and the reason why the bond yields are so high is we have so much debt. The governments are selling so many bonds, they've got to increase the yields or the interest rate to entice the buyers to buy them. And they're demanding higher rates also as the debt continues to increase. So it's a vicious cycle we're dealing with. Now, some people discuss, when I get into this, they start getting really nervous about the whole system crashing. I understand why those concerns exist. But I also have shared on the show about a month or so ago, one of the largest economic models ever done. They used NASA computers and Amazon computers and did a war game scenarios, much like how the Pentagon runs war game scenarios. If nothing changes, what's going to happen? And the most likely scenario that the computer model came up with was, if nothing changed, the U.S. would go into a debt-death spiral in about 20 years. So is the situation bad? Yes. Is it imminent crisis? Probably not. We have some time to fix this, and the Trump administration is taking active steps. They're aware of this, so that's good news. They're doing everything they can to bring in more investment into the country, tariffs, all these types of things to get our economy growing faster than the debt's increasing. That is a possible way out of this mess. Other studies from that have shown that if we can increase our average GDP growth by 3% a year, which is about the historical average, by the way, our debt to income ratio doesn't increase. Currently, we're at about 120% debt to GDP. So think of that as a debt to income ratio, because GDP is what you make, or what a country makes. If we grow at 3% annually on average, the debt to GDP ratio does not increase. In other words, it doesn't get worse. Our situation isn't ideal, but it's not at acute crisis yet either. If we can get something above 3%, say 3.5% or so, we can start bending the curve. In other words, our income will increase faster than our debt is increasing, which is a solution what any household or business does when when they're in a situation of too much debt. What's the solution? When you have a lot of debt, what do? Increase income, reduce expenses, right? That's the two solutions. And you try to do both. The Trump administration and Doge and Elon initially were taking the approach of reducing spending. Now, frankly, if they had been more successful at that, that would have been a quick and easy fix. If you reduce spending, you fix the problem quite quickly. But Congress dug their heels in and refused to reduce spending by any significant amount. Elon got very frustrated about that, rightly so. You've also seen, though, at the same time, the Trump administration changing directions, changing tactics in terms of working on increasing growth, increasing investment into the country, increasing the income. And based on what Trump has accomplished so far, he has pledged about $15 trillion investment into this country in the next 4 years. Now, I don't think anyone realistically thinks all of that's going to happen, but let's say half of it happens. More than that could happen. Let's face it. I mean, he's not done. But let's just say half of that happens. Even if we had 7 or 8 trillion of new investment into this country over the next 4 years, that will have a tremendous economic income impact in our economy, and it's real income, real impact, not just concentrated in a few tech companies, if you know what I'm trying to say. I'm not against tech, but our economy has kind of gotten pretty concentrated in a few areas. This would broaden out the economy in much more broad base, much more resilient, building real things like ships, computer chips, cars, whatever, stuff that we need. This is actually good for jobs, increase income that way, which will increase tax revenues. A lot of positive that can occur over the next 2, 3, 4 years. But understand, like anything else, these kind of changes don't happen overnight. We're already starting to see a few things benefiting, which is good. So again, there's reason for optimism. I'm not a total pessimist. In fact, I'm far from it. But I do believe there's a lot of volatility in the meantime through this transition period over the next couple of years, which we're in the midst of and we're starting to see. While all this is going on, consumers and businesses are really struggling because they've had to deal with historic levels of inflation over the past several years, and all of that adds up. Just because inflation levels are at about 3% annually currently doesn't mean that prices are going down. No, they're still going up. They're going up slower than they were before, but they're still going up. And when you add that up to everything else out there that's gone on, a lot of people, a lot of businesses are really starting to feel the strain. And part of that is showing up in terms of debt. And it turns out, according to the National Foundation for Credit Counseling, they're saying it doesn't really matter the income level. They're finding that there are many Americans now with significant incomes, but also have significant debt that are really struggling. They're starting to run out of their credit card limits, for example. Credit card debt is at its highest levels we have ever seen. It continues to increase, and that is a short-term fix, not a long-term solution. As debt continues to increase, it delays the inevitable, but it doesn't eliminate the problem. And eventually, these folks that have taken on too much debt, much like the federal government we discussed, will go into what's called a debt death spiral. They will be then forced to spend less money because they just won't have it. The interest payments on the debt will overtake and become too large that they can't afford their other costs of living, which means they will reduce spending, increase income, or file bankruptcy. And this is why I'm so concerned about the Federal Reserve if they do indeed reduce interest rates, because that could likely spark inflation, which for a lot of Americans would just be the death blow. They're already, from a debt standpoint, on the edge. They're on the border. And an increase, any kind of jump at this point in inflation could be the final straw. And that's one of the things that I really, really am concerned about. I'm not the only one. Many financial experts are pointing out that the error of the Federal Reserve and Jerome Powell has made is immense. And again, it goes back to allowing interest rates to be so low for so long. They created this problem. They created this bubble. The excess government spending added fuel to the fire, no question. And now they're really in a rock and a hard place. What do? All this is causing governments to face increasing interest rates, increasing interest payments. Investors are demanding more to lend because of the increased risk. And fiscal stress is spreading across economies one by one. And although, yes, the United States has a lot of problems, we're not perfect by any means. We're still the strongest economy in the world. Positive side of it is these things are coming, but it's probably going to hit other parts of the world before us. But the way the world is interconnected economically, a recession in one area could spark one in another. These are all some of the longer term risks. If I was a betting person and if you asked me what's the most likely scenario, and that's just, again, not me, that computer model I referred to earlier, where they use the NASA computers and everything, came up with the same answer. What's the most likely scenario going forward is we fall into kind of a 1970s type stagnation type of economy where interest rates are higher than average for quite a while. Inflation continues to float around higher than average for quite a while. So you've got slow growth, high interest rates, higher than average inflation. It's just not a pretty scene. And if you look at like what the stock market did or asset values did in those types of places, it was ugly. It wasn't a pretty situation. What shined in that scenario? Fixed assets, anything interest rate sensitive, because again, it was higher interest rate environment. The personal bank policies that I deal with today, dividends were 12 and 14% back there. So were annuities. Now we're not in those rates today, but it's definitely ticking up and ticking to the upside. Again, annuities will pay 8% guaranteed first year, A+ rated companies. You also can choose unlimited upside options potential with index options with no downside risk. If you have an annuity that's over 2 years old and you have a penalty to get out, I've got companies that will pay you 15, 17% bonuses to get out of it and offer you higher potential upside returns than your current account, your current annuity has. Some of them are so good, so much better. Their guaranteed minimum is higher than what people have been getting paid on their older annuities. So you get paid a bonus to get out. So you're ahead of the ball game by 5, 6, 7, 8% or more day one from where you were, including your penalty. And your upside potential is guaranteed to be higher than what you've been earning previously in your older annuity. That's how much better it is today. I've never seen anything like this in my 26-year career. And it hasn't been like this in over 40 years. It is truly the golden era of fixed assets. If you want more information, contact me at yourpersonalbank.com. Stay tuned in the last segment. I got some information about the real estate market. I've not discussed much about this lately because, again, everything, the news that's going on in the stock market, there's a lot going on with the real estate market too, so don't miss it.
Stay tuned for more common sense from Ferenc. For more information, contact Ferenc at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. Welcome back to the Your Personal Bank Show with Ferenc Toth. Want more information? Contact Ferenc at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. Now back to the show with Ferenc Toth.
Welcome back to the Your Personal Bank Show. This is Ferenc. If you want to reach me, you can do so at yourpersonalbank.com. Yes, you will reach me. It's yourpersonalbank.com, or you can download the Your Personal Bank app. You can listen to this or any of the previously recorded shows anytime you want. Each has its own title. I think you'll find it very interesting. So as we've discussed earlier in this show, some of the short and longer term risks I see to the markets, the economy, things like that. In general, the shorter term risks, I believe, is the historical valuations that we're seeing in the S&P 500, the tech stocks. As it continues to go higher, the risk intensifies. We're already at all-time highs, highest valuation levels the stock market has ever recorded. This includes 1929 and 1999. We're living history, folks. How much longer this can continue is unknown, but the risks are certainly elevated as it keeps going into the stratosphere. And the cracks are starting to show in the whole AI bubble, the whole AI hype. A lot of situations are coming up. Some problems are starting to appear, and a lot of investors are getting concerned. So if you're in that arena, you might want to reconsider or pull back or protect yourself, because when the bubble does burst, it could happen very aggressively and very dramatically and very quickly, faster than you can react, perhaps. So that's something to be aware of. There's a bigger long-term risk, though, that I'm even more concerned about, and has to do with the bond market and the yields. It's being driven by two primary factors: the historic level of debt that the federal government has, and governments around the world, actually. The UK has dropped interest rates 5 times, yet they have the highest yield interest rates on their bonds in 27 years because they have debt problems like the United States. This isn't going away anytime soon. Bond yields are going to stay strong. Bond investors are demanding higher interest rates because of that risk, which means higher interest rates, higher for longer, typically not good for asset values like stocks and real estate. Which brings me to the debt issues, both consumer debt. We're at historical all-time levels with credit card debt. That is not a good sign. That's not pretty. These are people that are borrowing at double-digit interest rates. I talked to somebody last week. They had borrowed some money on a credit card. It was a fairly significant amount for them. And originally they had a good rate of 12%, and they just bumped it to 33%. Well, that's impossible for them to maintain. They're now negotiating and working their way out of that debt. But the reality is, and I was able to give them some advice and help on how to accomplish some of that to make it a little better. But as we continue to see more and more of that, that's going to have an impact on our economy. We're also seeing record business bankruptcy filings. Turns out we're at the highest levels of business bankruptcy since the Great Recession. And another thing that's really concerning to me is the jobs numbers are about to be revised, apparently by another 500,000 to 1 million for the past 12 months, according to Goldman Sachs. If indeed the government reduces the jobs numbers from the previous year by another 500,000 to 1 million jobs, that would be the biggest 12-month downward revision in over 15 years. The total cut over the past 2 years would be over 1.5 million jobs. Because I don't know if you remember, after the election, the Biden administration downward revised 800,000 jobs that they previously had reported, turns out never existed. It turns out there's another 500,000 to 1 million apparently that never existed that were on the books. These are not reasons to be positive about the economy currently, at least in the short term. And I'm an optimist in the longer term. We've got some short-term challenges we got to deal with. Now, I also have mentioned several times, when you have a debt problem, there's two solutions to that. You can increase your income or reduce your expenses. So far, our government's not doing a very good job of reducing spending, but there are some good news in that front. Turns out recently, DOGE has removed 11 million scammers from the Social Security system so far. On average, each fraudulent person was getting $1,800 a month. Adding all that up comes up to about $20 billion every single month that was getting paid out by Social Security to scammers, people that did not qualify and should not have been on the system. I've even discussed on this show and have had former Social Security administrators I've interviewed discussing the challenges of Social Security running out of money in the next, the predictions were like the next 7-8 years, in fact. If DOGE and the government can reduce wasteful spending, fraud, things like this, that will extend the viability of these programs. This is something everyone should be in favor of, and I think most everyone is. Also, another spending cut provision that's coming out, that shocking that it was even existed, but now it turns out HUD will now require proof of citizenship to receive Section 8 housing. The fact that this wasn't a policy before just shows you how corrupt and inept our government has been. That will probably save billions of dollars too. Wherever the government can spend less money will help. Anything they can do will help. And these are good things. But when it comes to the real estate market, for example, one area that's extraordinarily bad is the commercial market. And it turns out the rate of office mortgages, the office delinquency rate, is now officially higher than it was during the Great Recession of 08-09. So we're seeing the highest vacancy rates we have ever seen. And this is something that's going to impact a lot of, say, smaller and regional banks negatively, because those are the lenders that primarily funded commercial real estate. So we could have some challenges with some banks staying viable as those loans fail. There's been a lot of refinancing recently. Here's the other part about commercial real estate, whether it's multifamily or commercial. Those typically are not done like 30-year fixed mortgages. They're typically done in about a 3-year period, and they're adjustable. So they're adjustable rate mortgages. Well, if you had a commercial loan 3 years ago, your interest rate was probably very low. Today, it's probably more than doubled. There's a saying in the commercial real estate world called extend and pretend. And the reason this is happening is, again, you're talking about an office building or a big commercial property. These are sizable loans. These are often handled by mid-size or regional or even small banks. So they have a significant amount of risk involved in the transaction themselves, and they don't want it to fail either. When the loan comes up for renewal for its typically every 3rd year variable rate, and they show the vacancy rates and stuff like that, they can negotiate oftentimes with the banks to extend that loan at a more favorable rate. Both the bank and the owner of the building are both hoping that things will get better in the future and this won't default and blow up in their faces. That's why it's called extend and pretend. The only way that really works is either interest rates have to go back down or vacancy rates have to come back up, or both. And I just don't see that happening anytime in the near future. COVID changed how people do business. It's far fewer people going to work in the office. I don't see that changing anytime soon. And it doesn't look like interest rates are going to go down a whole lot in the near future. They might a little bit. Housing market has hit the all-time most unaffordable level in history. And this is going back to numbers that track all the way back to 1890. I mean, again, we're living history, folks. And so that's why we're seeing the worst home buyer demand on record. It's the most unaffordable ever on record. Eventually, something's going to break. Sellers have been holding the line because they used to be able to get a whole lot of money for their properties. They got used to that. The real estate market tends to move a lot slower because there's a lot of people involved. Many of the sellers have equity in the property, so they not necessarily have to sell right away. But life has a way of happening. Things happen where you get job changes, or the family grows, or somebody passes away, or there's any number of reasons where they're going to be forced into a situation where they have to sell. And as we see more and more of that, and inventory has come up, no question, because the home buyer demand is the lowest levels we've seen ever, something's going to give. It's like a big game of chicken. Who's going to win this game? And the reality is many buyers don't have to buy, because the one other positive thing that's happened is rent prices were going up quite a bit, but that's tailed off. It currently in most places in the country is actually cheaper to rent financially than own. Yes, most people would prefer to own. I understand that. But if it costs too much, they just can't afford it, because wages have gone up some, but not near as much as real estate. I mean, if you can't afford it, you just can't afford it. So you're going to rent. I think the buyers ultimately are going to win this game of chicken, because the buyers don't have to buy, and many of them can't afford to anyway. The average American cannot afford the average house today. Only about a third of Americans today can afford the average home. Real estate's tends to move a lot slower than, say, the stock markets. So this could be a slow-moving process as it goes. But that's what seems to me to be the most likely scenario. Unless you need to buy something right now, my recommendation personally is you probably might want to wait a little while. Stay where you're at and manage to do that for the foreseeable future, maybe the next year or two. It might benefit you financially. If you want more information to learn how to thrive through this golden era of fixed assets, increase your returns safely, insured, guaranteed, tax-free, highly liquid. You can get unlimited upside potential with no downside risk. I mean, create positive arbitrage, put yourself in a better position financially. Let's say you're saving up for that house like we talked about before, and you want to put yourself in a better position to be able to buy it in a year or two. I can show you how to do all those things, or pay down some debt faster, negotiate things, whatever you need to do. This is the stuff that I do on a daily basis. Or you just want a better return. Maybe you have an old annuity, you want to check it out with one of the newer ones and increase your returns and get a nice bonus in the process. Or you want to reduce your market risk because you're a little concerned about where things are at right now, being the highest it's ever been. Any of those kinds of situations is what I've dealt with for the last 26 years. Be happy to help you with it. Also, contact me, yourpersonalbank.com. Stay tuned to next week to the Your Personal Bank Show, and as long as it's on our money, in God we trust.
Listen Tuesdays at noon and Saturdays at 1 to the Your Personal Bank Show for more information. Contact Ferenc at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. This show is designed to provide accurate and authoritative information. The presenter and guests of this program do not engage in legal, accounting, or tax advice. Professional advice regarding your situation should be sought if required. Some products discussed may have limitations and not be available in all states. Excessive unpaid loans may affect performance. Distributions may become taxable if not managed properly. Replacements may not be suitable for everyone. There may be charges when replacing coverage. Dividend rates and bank line of credit rates may change. For current rates, contact Ferenc at 866-268-4422 or yourpersonalbank.com. Again, that's 866-268-4422 or yourpersonalbank.com.